Hello, everyone, and welcome into CrushTheStreet.com. I'm Kenneth Amaduri, and I'm joined today with Rick Rule, President and CEO of Sprott U.S. Holdings. And we're speaking to Rick at a time with gold at $2,000, silver getting awfully close to $30. It's an exciting environment, and I'm looking forward to speaking to Rick himself. Rick, thanks for coming on the show with me once again.
Always a pleasure. Thank you for having me back.
Sir, simple question. I want to get your reflection on gold, $2,000, and silver doing what it's doing here in August of 2020.
Well, I need to say, as a buyer, I'm probably different than many of your listeners. As a buyer, somebody who was interested in owning more gold and silver, I frankly like the gold price better at 1,100 than I do at 2,000, and I like the silver price better at $15 than I do crowding 30. That being said, the reason that I wanted to own gold and silver and still continue to want to own gold and silver has obviously become more apparent to more people, and so the price is in fact higher. I do believe, after that disclaimer, that the circumstances that caused the gold and silver price rise to occur are still very much intact. And I would be very, very surprised if they didn't continue to increase in price.
You know, it's interesting that you talk about that because arithmetically that makes a lot of sense, buying gold at $1,200, $1,300, silver in the teens. But seeing this move higher is giving a lot of people confirmation and that conviction to be able to buy, because at gold, $1,200, $1,300, people didn't know if they were going to need to wait 2 years, 5 years, but it almost feels like we're imminent now because of the move we've seen. The next move higher, it feels sooner rather than later.
I can't comment on that in the near term. In my experience, and for your newer viewers, that experience goes back to 1970. I've been in this game a very long time. Bull markets in precious metals, secular bull markets in precious metals, always feature cyclical declines in the midst of those secular bull markets. So people need to be associated with the reasons why gold and gold stocks go higher, rather than merely relying on the market for their information. It wouldn't take very much at all to see the gold price fall from $2,000 an ounce to $1,600 an ounce. Ironically, that 20% decline, where gold became arithmetically 20% more attractive, would scare out more speculators than it would attract. Human nature is very, very, very odd. I remember well the first gold bull market that I experienced, which was in the 1970s. In the first half of that decade, 1970 to early 1975, the gold price moved from $3,500 an ounce to $200 an ounce, a very handsome six-fold move. In 1975, the U.S. interest rates went up, strengthening the U.S. dollar, and the gold price fell from $200 an ounce to $100 an ounce. A 50% cyclical decline in a secular bull market. Rather than having the courage of their convictions, tens of thousands of investors sold out in 1975. And when the bull market resumed and the gold price went from $100 an ounce to $850 an ounce, those people watched from the sidelines. The point of this is, don't follow the near-term price action. Don't even concern yourself with the near-term price action. Understand why you own these assets. Gold, silver, gold stocks, and silver stocks. They're different asset classes. And if you understand why you own them, you will have the courage to own them through these cyclical declines. If you don't, you will become a victim.
Rick, maybe you won't like this question, but I'll ask it anyways. When we saw the March bottom out, the overall equities sold off, and then we saw the crash in gold and silver, we soon resumed with the bull market. And I think it says something about the confirmation to the upside that investors are feeling. So my question is, if we see another crash in equities, would you suspect that gold and silver stocks will go down as well? But because of the recency bias, people might be more inclined to buy the dip and to get right back in because of what happened in March?
My own belief is it depends on the reason for the decline. If the reason for the decline is a crisis in confidence, in particular a liquidity crisis, certainly gold and silver stocks, two different asset classes, will sell off. The market response will have less to do with recency bias than it will to the policy response associated with the liquidity crisis. If the political policy response is even greater liquidity, which is to say more quantitative easing and more artificially low interest rates, then you will see what you saw in March. It wasn't the fear associated with a crash in equities that propelled gold and gold stocks higher. Rather, it was the policy response and the understanding that the investment community had of the impact of the policy response on the ongoing purchasing power of US dollars and US dollar denominated sales. So it very much depends on the nature of the decline in terms of gauging the investor response.
Yeah, that's a good point. Sir, I'd like to ask you about the bottoming out of this sector. I mean, I have not had an opportunity to reflect on such a cleansing that has happened and witnessed in a market, the resource market in particular, the capitulation that we saw. It really was a function of higher prices that turned the market around, where these gold miners started to produce more earnings and fundamental valuations went up, but really zero speculation. So it was the most cleansing bottoming out of a market that I've ever seen. And here we are going into this phase of the bull market. So maybe touch on that, if you would, just the purity of that bottoming out that we saw.
Well, what you say is very true. And I will be referring throughout this interview to a chart that we use to illustrate this market, which is the Barron's Gold Mining Index 50-year gold equities chart. What you will see consulting that chart is that there have been two prior gold bull markets. I believe that we're in the third now, and that there have been 8 prior gold equities markets recoveries from oversold bottoms. And it's important to note that the precious metals market is nothing if not cyclical and volatile. In interviews that you and I did some years ago, you will recall that I always use two phrases. The first is that you are either a contrarian or you are going to be a victim. The second is that low prices are the cure for low prices. The market that we saw through the last decade, the period 2010, 2011, through 2019, was really one for the record books in terms of bear market and cleansing. The gold price falling from $1,900 to sub 1,000. The gold equities falling by a greater extent. And amazingly, the junior gold indexes, the Toronto Stock Exchange Venture Resource Index being the most dramatic, falling by 88% in nominal terms, and in fact more in real terms. Those are precisely the sort of cleansing events that a speculator or an investor, either one, wants to see. And as you suggest, the recovery that we have seen has partly been simply a recovering from an oversold bottom. I don't think that you are seeing very much generalist attention to the gold or silver equities markets yet. I still think that this is a very, very, very small asset class, and it's being viewed as a sideshow by most investors.
Yeah, absolutely. Well, it's interesting what we're seeing with Buffett and his purchase of Barrick. Do you believe this is symbolic of where we are in the bull market now?
I think it's symbolic, but I think it's symbolic for a reason that gold bugs miss. And I think it's extremely important. Buffett doesn't need to own gold. Buffett is a very disciplined human being. He has enormous piles of cash, and he owns businesses that do well during good times and bad. He owns businesses that have pricing power, that can survive inflation. Buffett is not making a bet, as many people would suggest, against the US economy. Rather, Buffett has looked at a company that happens to produce gold, Barrick, and he has seen a future revenue stream that is very cheap. He looked at Barrick and he looked at the enterprise value, which is to say the market cap plus the cash minus the debt. The enterprise value is what a buyer would pay for the whole business in the theoretical event that they were able to buy the whole business for the share price today. And then he looked at the margins that they're generating on current sales and the margins that they are likely to generate from reserves and resources on the balance sheet, and their ability to reinvest the surplus at similar high margins, and determined that Barrick was simply a cheap business. That is much more important than Buffett's puny bet on the gold business. It's important to note that he didn't invest in gold. He invested in a gold equity that was cheap. And what people need to understand now is that the cash generating ability of these businesses, now that their balance sheets are clean, and now that the selling price of the product has increased from $1,100 to $2,000 an ounce, the margins for the next few years and their ability to reinvest free cash flow in projects that make great money at $1,500 or $1,600 gold, never mind $2,000 gold, projects that were completely uneconomic, at $1,000 or $1,100 gold. It's this outlook for the gold mining industry and the fact that Buffett saw Barrick as cheap, irrespective of what it is they do for a living, that people ought to be paying attention to, and it's extremely bullish.
Absolutely. Well, and it's interesting, it circles back to what we were talking about before about the resource sector bottoming out and being cleansed, and Buffett saw value in Barrick, and as opposed to many other general equities. We talked about that capitulation that happened in the resource sector. We really haven't seen that happen in overall stocks. It's just been pullbacks and buy the dip moments, but there really has not been over the last 10 years a capitulation in the equity sector. And I think it goes to show where Buffett was able to find true value. Any thoughts on the overall equities not getting that flushing out of bad money and debt and all the things that are going on with the easy money that's coming from the government?
Well, I certainly agree that the levels of the indexes in the general equities markets have been stimulated by artificially low interest rates and artificial liquidity. I think one makes a mistake to lump all of the non-resource equities into one bucket, because certainly you're seeing a circumstance where microcap and small cap markets have disengaged from the equity market rally. There are lots of $500, $600, $700 million market cap companies that are, based on Buffett's criterion as an example, cheap. What we have seen is an incredible concentration on ultra-large, ultra-liquid, large capitalization companies and 7 or 8 very large technology companies. Whether or not the growth in both sales and margin that the large technology companies have exhibited can continue at a pace that's high enough to sustain their market capitalizations is probably a question that you would have to address to a technology analyst. I don't understand those businesses well enough that I can afford to pay the prices that are being asked for them. But I would remind your listeners that general market equities are not one class. They are a variety of different investment classifications. And the escalations that you've seen in the pricing of those businesses hasn't occurred across the board. Rather, it has been concentrated in very large companies. One would call them in an ETF the dividend aristocrats, and also in the very, very largest tech names. This has not been as broad a based rally as people suggest it has been.
Rick, you're a legendary resource investor, and I'd like to get your thoughts on the importance of people and investing in the mining sector. I find it interesting, what you were talking about and the conversations we're having in the cycles. You said, hey, it was exciting as a buyer to be able to get gold at $1,200, $1,300. And we've seen some of the best management teams in the sector be able to capitalize, being able to acquire ounces in the ground at great discounts. And I'd like to get your thoughts on Amir Adnani of gold mining, if you would. I know he controls one of the largest gold resource portfolios across all juniors in the Americas, and he was able to acquire that in the bear market. Now, I'd like to separate, we kind of know what the importance is of someone like this in the bear market, but is there anything you look for somebody like this when they go into the bull market, and what changes between a quality management team and a poor management team?
Well, a bull market is all about monetization. Following on the Amir Adnani theme, he has been active both in the gold space and in the uranium space. And as you note, he has been very astute at using a bear market to pick up assets that look, in retrospect, cheap. His challenge in a bull market, when his cost of capital goes down, is figuring out which assets to monetize, which is a fancy way of saying sell, so that he can use the resultant capital to develop his remaining assets without having to issue more shares, and figuring out which assets to advance, given that his cost of capital is declining and his ability to finance projects is increasing. You and I have talked in prior interviews about the real importance of managements in building companies. When a company is built, Buffett famously says that you want a business that's sound enough that it could be run by a moron, because sooner or later it will. What we're talking about in the sub-billion market cap space is building companies. And building companies is all about entrepreneurial teams. Most of the success, frankly, that I've enjoyed in my career has come about, A, by being a contrarian, but B, by identifying early in my career that wonderful group of entrepreneurs, people like Pierre Lassonde building Franco-Nevada, people like Bob Quartermain, Ross Beatty, Adolph Lundin, now Lucas Lundin and the Sons. And I would classify Amir Adnani as being part of the third generation of resource entrepreneurs who have come to understand cyclicality, have come to understand their cost of capital, have come to understand, frankly, financial public relations and brand building, which is a different way of saying lowering their cost of capital. And I think that management is all important in the sub-billion market cap space.
Rick, bringing up uranium there, I think seeing gold and silver go higher in this environment, a sector that was otherwise left for dead maybe a year or two ago, we know uranium ultimately will fundamentally need to go higher at some point. But I feel like what we've seen in gold and silver might give people the courage to start to believe in uranium turning around. Any thoughts on that?
I disagree with you. I think human nature is such that people always miss bargains. They need the affirmation of the price. In other words, the price has to go up to justify the narrative that supported the price going up. So mercifully for an old man like me, I can begin to forward shift into uranium while other people are focused on gold and scoop up the bargains. As you say, the uranium price will have to go up, but the truth is that it won't catch a bid. It won't catch a broad audience until the easy money has already been made.
So I don't want to insult your intelligence here, Rick, with this question, but this topic is being had on major platforms. Elon Musk is talking about mining gold on asteroids, and it's a real question for me. You know, does the threat of additional supply coming from space factor into your thesis in gold? And I'll add to this. I mean, this is what I'm saying: is if it's already cost prohibited in many instances to mine gold, mine silver here on Earth, my goodness, how are they going to be able to do it on an asteroid?
I've learned at age 67 to pay attention to the things that I can understand and ignore the rest. My ability to understand the costs associated with mining gold from asteroids means that my opinion on the subject is absolutely valueless. And given that it has no value, I spend no time on it. I would point out to you that new mine supplies adds about 1 or 1.5% to gold supplies a year. It's much less important than things like scrap. So I'm not particularly concerned about increases in supply, particularly terrestrial supply, in the next 10 or 20 years. And on a net present value basis, what happens in the next 10 or 20 years is the only thing that matters to you and I anyway. I think it's fun to discuss these things on internet forums, but the probability that we're right in the first instance and the probability in the second instance that it happens in a time frame that matters at all in terms of net present value is extremely low. What we will see, I think, is a number of projects that are owned by big companies and small companies that could not be financed at $1,200 gold with the share prices and the cost of capital that existed 3 years ago, getting financed into production and coming into production now. So we will see near-term increases in supply from deposits that were marginal at lower prices. Will that impact the market? Perhaps in the 3 or 4 year time frame, because it takes a long time to finance and permit and build these projects. The most important determinant of the gold price, though, is going to be the opinions of people who own the gold as to when they sell gold that they have in their own holdings, and the opinions of people who want to buy gold, which is to say how much gold, or rather how much insurance they require. Remember that the gold market is extraordinarily liquid. A lot of gold trades, and the opinion of buyers and sellers on existing inventories of gold matters a lot more to the gold price than increases or decreases in physical new mined supply.
Yeah. Well, one of the metrics I believe you were pointing towards maybe a year ago or so is gold as a percentage of overall portfolios was less than 0.5%. In this environment going forward, is this something that you're looking towards as a metric as to where we are in the bull market?
I think that's extremely important. To refresh your viewers' memories, there was a study published that suggested that the market share of precious metals and precious metals related assets as a percentage of the total matrix of investment and savings assets in the United States was less than 0.5%. It's important to note that the 3-decade mean market share of precious metals and precious metals related investment products was between 1.5% and 2%. So if all precious metals do is revert to the 3-decade mean, what that means is that demand for precious metals and precious metals related assets in the largest investment market in the world, the United States, will increase by 300 to 400%, which is to say triple or quadruple. I'm not talking about the doomsday gold bug scenario, the collapse of the dollar, the gold standard, all those things. All I'm saying is that if the market share of precious metals and precious metals related assets reverts to its 3-decade mean, then demand for precious metals and precious metals related assets will go from less than 0.5% to somewhere between 1.5% and 2%.
That's amazing. You know, Rick, another metric people look at is the gold to silver ratio. And Bank of America has gold going to $3,000 target. I know a lot of people have higher and lower expectations on that, but a lot of people are saying, you know, they're looking for a 30 to 1 gold to silver. And if gold goes to 3,000, I guess it's reasonable that silver can go to $100. Do these numbers resonate with you in terms of instinct?
Your silver bug listeners are going to hate me for this, but I believe the gold silver ratio is irrelevant. I believe that prices are set by utility, not by scarcity or abundance in the Earth's crust. Remember that most of the gold that's ever been mined hasn't been used. It still sits there in inventory, while silver itself has broad industrial applications. Remember, too, that gold is produced from gold mines, but silver is produced as a byproduct of mining other materials. So I actually think that the price of silver and the price of gold are disconnected to each other in the context of the gold-silver ratio. The gold-silver ratio is probably important as a psychological determinant. While it's irrelevant really in terms of value, I think it has near-term implications in terms of price. It's a factoid. It's something that's true that is likely irrelevant that people pay attention to.
Rick Rule of everyone, Rick Rule of Sprott US Holdings. Rick, if people want to learn more about you, the work you do, how they can reach out to you, please let them know where they can go and what they can expect to find.
Thank you very much. I'd like to make them an offer, actually. Anybody who would like to become familiar with our work, I'm going to give you an incentive. I personally will rank your natural resource portfolios. This won't be investment advice, but I will rank the companies 1 to 10, 1 being best, 10 being worst. As an added incentive, I will send you the Barron's Gold Mining Index chart that I talked about, and a 100-year commodity chart, which shows the relative valuation of commodities versus other important parts of the economy. You may obtain this by going to a web link, www.sprottusa.com/rankings. That's www.sprottusa.com/rankings. You will see a web form there, and you enter your natural resource stocks on the web form, and we will send you back rankings of your portfolio, comments on individual companies where I think my comments might be of value, the Barron's Gold Mining Index Equities Index chart, which I think is the best illustrative chart of where we are in relation to prior bull markets, and also a 100-year commodity chart.
Well, what a great call today, Rick. I appreciate your time here with us at Crush the Street.
Always a pleasure. Thank you. I look forward to doing it again.